Good afternoon, and welcome to the University of Miami U-Talk series on real estate transformations. My name is Chuck Bowl, and I'm the director of the Masters in Real Estate Development and Urbanism at the School of Architecture here at UM. This is the third of our virtual real estate impact speaker series, which is being organized by the real estate programs in our schools of architecture, business, and law, with the support of our real estate advisory board members, many of whom are joining us today, including three of our panelists. UM is unique in our interdisciplinary real estate educational curriculum. This fall, I had the pleasure of welcoming 60 graduate students from 8 different programs and 4 different schools to our Intro to Real Estate Development course, and many of them are joining us today as part of this speaker series. It's actually an extension of our morning class discussion, which got into a lot of discussion on residential. We're also joined by many of the 100 members of the 3 different real estate advisory boards at the University of Miami, and many of the previous attendees of our annual Real Estate Impact Conference. So welcome to everyone. This month, we shift our attention to the residential sector, where we have a fantastic panel to address the topic of the new residential landscape, what's next, who's moving, where to, and what do they want? And to help us answer those questions, we have Howard Lorber, President and Chief Executive Officer of the Vector Group, also a valued member of the University of Miami School of Business Real Estate Board. We have Fred Rothman, the COO of Lennar Corporation, who's with us on the Real Estate Development Advisory Board, and Ryan Shear, who's managing partner with PMG, also an MRED board member. Leading the discussion today is Ivy Zellman, who's the Chief Executive Officer of Zellman and Associates. A few logistics during the panel. Only the panelists will be on screen. If you have a question for one or more of the panelists, please submit it via the Q&A in Zoom, and we'll get to as many of those questions as we can at the end of the panel discussion. Just a bit more about Ivy Zellman Associates is a leading housing research firm nationwide and serves institutional and private equity partners, corporate executives from the home building products, real estate, mortgage finance, and rental sectors. So she is the perfect person to lead this discussion, which is cutting across subsectors of residential. Ivy, we want to have you come back and describe your methodology to the students, because it's really interesting, and they're currently working on their annual survey that they do as part of the University of Miami commercial real estate program. So welcome, Ivy. You have the floor, and thank you everyone for joining us.
Well, it's a pleasure to join everyone today, and we have really an incredible group of panelists here today. So first thing I'd like to do is start with each of the panelists. Just tell everyone that's listening virtually here about the company. So Fred, Lennar, everyone knows Lennar is maybe they don't, but Lennar is a publicly traded home builder that's national and the largest in the country. Maybe just for the perspective of how many units in 2020 did you actually build, and what was your average price point, and maybe what you think you'll do in 21, at least what you're allowed to say, Fred, that you've publicly provided.
Okay, thanks, Ivy, appreciate it. And thank you for hosting this and for the entire university. We are also proud to be the only public home builder based here in Florida, and more importantly in Miami. So we take a lot of pride in the local activities and look forward to continuing to support the university. The Lennar is, depending upon the statistics you look at, the largest home builder by profit margin and profit, and we're proud of that. And across the country, we are in 40 different markets, virtually every major home builder market under historical terms. And we can talk about what that means as the sands are shifting as to the typical markets and where home buyers are moving to. Last year, we did 52,000 plus closings. Our vernacular, we call them homes and home sites. You'll hear me refer to that throughout the day as we use our culture and how we describe what we do and who we do it for. This year, I think we've guided Wall Street, Ivy, to 62 to 64,000 home closing range as we begin the year. We're a one-off fiscal, so our fiscal started December 1st. So we're getting ready to close our first quarter for the
What
year.
was what's your average selling price?
Well, it's moving down the spectrum. We're now in the $400,000 range. We've been, some of the outer markets used to be called tertiary markets. We don't like that term anymore because nothing's tertiary post-COVID. As we continue to move out of the core areas, we're getting lower and lower pricing, adding to the fuel and the fire of what's going on in the home building market right now.
Right. We like to call those markets either extremely suburban or exurbs, which are really, think about the third ring of a metropolitan area, but certainly a lot of activity out there and really trying to provide affordable housing, which is really the nation is struggling so much with providing shelter. So Ryan, why don't you tell us about yourself and PMG and how many units in multifamily for rent do you do? And I know you do high-rise condo, and so I'll have a lot of questions. So just go ahead and start, and I'll interrupt.
Sure. So we're a 30-year-old company. We started in New York by my partner Kevin Maloney, and we pre 2008. I feel like we did everything. We did from golf courses to horse farms, condos. I'm a Miami kid, so I have a special endearing place in Miami. And after 2008, we did somewhat of a restructure more towards the residential space. So a lot more core focus on ground up multifamily and condominium.
And how many units in multifamily? I know you were across the nation for rental.
Yeah. No, we're, I want to say this year we'll have 2,000 to 3,000 open, and in the pipeline, like in some form or fashion of development, north of 10,000 the next 24 months.
Great. And on the for sale condo side, you're in New York and Miami.
So yeah, so as in the condo space, it comes and goes pretty quickly. So if you asked me last year, I would have told you 0. And if you ask me this year, we're currently going vertical in Longboat Key and a bunch of spots in Miami. New York, we're finishing up a piece in Leroy in the West Village and a piece on 57. So, condos, in our opinion, you get in, you get out quickly, you got to ride the wave and make sure you ride it appropriately. But we're across country. We're true ground up residential developers.
And with respect to the multifamily portfolio and the few thousand units you have, is it Class A? And what's your average rent roughly?
So it's a little bit of a tricky question to answer. The Class A is yes. I mean, we have an affordable division, but everything's primarily Class A. However you define Class A, but all core cities, Miami, Fort Lauderdale, Denver, Orlando, and so forth. Because we offer a rent by bedroom program, which I'm sure we'll talk about at some point today. The entry point in our multifamily is actually, it's at a discount to almost, the thesis for our business is it's a feeder point to the multifamily that offers an entry point that other Class A properties can't, because you're renting the bedroom, if you will. So technically our entry point is 1,200 or 1,100 in, downtown Miami and downtown Fort Lauderdale, but it's really because they're renting the bedroom versus the apartment as a whole.
Okay, great. Howard. So Howard, as the chairman of Vector, is also operating within Vector. You guys own Douglas Elliman, which is the leading real estate brokerage firm within New York and Miami and LA. Why don't you tell us about Douglas Elliman and give us some idea of the size and roughly the cities that you operate in?
Sure. Thank you, Ivy. It was an interesting year, to say the least. Our biggest market, obviously, is New York and New York City. And when that was closed down by the mayor and the governor for a few months, where you couldn't do showings, sort of ground to a virtual halt, we did do some business during that period of time. But on the good side is that has subsequently changed as the markets opened again, but also we've experienced record sales and volume and prices in all our other markets. And the predominant markets are South Florida. I would say that, and I've said it many times before, Miami and Palm Beach, I believe, were the 2 strongest markets price-wise and increasing prices in the world, based on everyone I've spoken to and everything we've seen. It was just phenomenal what has gone on. It's sort of like in Miami, we were in South Florida, I think Miami and Palm Beach, we were contracting $300 million a week for the last 10 weeks at the end of the year. I mean, just unheard of. And the prices would have been more, but what really happened more so in Palm Beach, which is a smaller area, there was no inventory. So what had happened is prices would go up and then some more inventory come on the market. And then that would be sold quickly and then prices would go up again and more inventory would come.
It's really been the story nationwide, but beyond, you're not just in South Florida. So you're also in now Texas, LA, Boston.
Yeah, we're in the surroundings, the suburbs, the Hamptons as an example. I think we did 2.5 times the business we've done in the prior years. Okay.
Yeah.
And volume prices have gone up more modestly than some of the other markets. I think in the Hamptons price went up about 10 or 12%. South Florida in general was up big, as I said. Long Island, which is the rest of Long Island other than the Hamptons, was very strong with prices up moderately, but volume up substantially. Out west, our big market obviously is California. We were up. Prices were not up that much there, but the volume had picked up quite a bit and continues into the new year. Aspen, another small market that we're in, you couldn't buy anything quick enough before it was gone. So that was a boom year. And Massachusetts, and all these we've had sort of record high-end prices also, which is interesting. And like Greenwich, which was very dead for quite a while, we sold the house for $40-something million, which is the highest price sale in many years.
Right.
It was in the paper, so I can talk about it. It was Tommy Hilfiger's house. And in Westchester, we had a huge sale. And in Boston, we're smaller in Boston, but we sold one of the highest priced houses there in the 20s in one of the suburbs of Boston. But overall, we did, I haven't seen the final numbers yet, but probably between 28 and $30 billion of sales for 2020.
So up from a sales, not from a closing perspective, year over year, you're north of 20% in dollars or revenue growth.
Well, I look at commissions. So,
right.
But that number is sales prices. Okay. Right. We were down in New York volume wise and price wise, and we were up volume wise and price wise in every other market. But having said that, don't forget New York is the biggest market.
Right.
The biggest market. We have about 100 offices throughout the country and about 7,000 salespeople. But the big money always came from New York City.
Right. And New York, certainly New York is the exception right now in the country as it relates to the activity we're seeing. Just to give everybody some perspective, 2020 started off as a strong year for both the new market as well as the resale market for sale. Multifamily was doing well, but it had been decelerating from really robust growth, and rent growth had been decelerating, but still healthy, with across the board metrics still positive. But the new home market was really gaining traction, very strong results from selling new homes, especially as builders. I like to say they finally got the memo. I used to say, if you build it, they will come. And a lot of builders were reluctant to go out to the exurbs. And finally, they really in earnest. And now you're the prettiest girl at the dance if you're building entry-level housing. So Fred, will maybe go to you and talk about the remarkable, just, jaw-dropping response to this COVID pandemic that shut our economy down. Housing became center stage and everyone was hunkered at home, working from home if they were capable of working from home, other than, of course, our frontline workers and even teachers were working from home. So everyone was home. And now all of a sudden they're looking at their homes, whether they're in a multifamily unit, and they're saying, I'm going to kill my husband or my kids, and I need to get larger space. And I want larger, not only larger space, but higher quality space. And you just saw this explosive growth that became to fruition. And so maybe first starting with you, Fred, on the new home side, and then we'll kind of walk around as we see, we call it the Great American Shuffle, which had well been underway prior to COVID. So we see a migration from what would be less favorable climate states, whether it's the New York area, Midwest, Northeast. Those markets had been growing only over the course of 2010 to 20, call it 3% in terms of household growth. Compare that to a lot of the mountain states and southeast and southwestern states that are growing 15 to 20%. So take COVID now, and then you get a shot in the arm of a steroid, and it's just gone nuts. So talk about the expansion you're seeing in these markets that were already growing. Is it just today boundless? Are people coming from New York and all of those colder climate, less favorable tax states? Are you seeing a lot of transition into who are your buyers and where are they moving to?
This is like an earnings call where you had two questions that turned into 20. So my answer, I think, is yes, yes, no, no, yes, and maybe. And now I'll walk you through those. COVID was a first time in my 37 years of an economic crisis that actually led to the growth of the home building industry. Usually we lead the economy down on a crisis and most times lead it out of the crisis as well. So one of the other interesting phenomenons of this terrible disease is it's really turned everything on its head. And from an economic standpoint, from a home building side and from a customer side, it accelerated, as you said, with unbelievable force, Ivy, trends that had been beginning. We've been waiting forever for the younger generations. Now there are all kinds of letters associated with them. But we've been waiting for them to make that decision to move out of what we used to call walkable communities, right? That was the big concept. Was your community walkable? If it was, you got a premium. Now, if it's walkable, it means, do you have a lot of open space and green space? And is there a lot of places to take your new children to go? And so we had seen the trends out of the cold weather states into the warmer weather states. Although I mentioned, just as a side, some of the surrounding states, as Howard mentioned, like Connecticut, New Jersey, which still have structural problems for taxes and other reasons, are actually doing fairly well, as those in New York who don't want to skip south are definitely moving out of the city into those more common suburbs, which I think have seen a little bit of a pickup.
But that's really, there's not so much new construction. We have some builders that do have some communities, but that's where we'll go with Howard, because that's really the boom is on the resale side. But certainly you're right, there's some activity, but relatively negligible just because there's no land. The density is so high.
Yeah, some of the markets are a little stronger, and even those, the outer markets in Central South Jersey, for example, Ivy, stronger than in historical because of this. But
Right.
Coming back to the bigger markets, and anything in along the southern half of the U.S., every market is at the speed and a desire that I've never seen. You probably have never seen either. The amount of buyers who want to buy a home now. Home ownership for many, many years had been on a decline. Our supply of new homes based upon family and home creation was way down. So all of the statistics were there, and we've talked about it for years, but COVID was the match that kind of blew it all up and said, you're right, all these statistics are coming true. So you have so many young families who I'd say if you had a kid or two and you were in a 1-bedroom apartment anywhere, you had to buy anything that became available that weekend. Right. And that was a huge, huge burst. And you combine that with not having to work in an office, and all of a sudden you can drive and live an hour and a half away from work without any identity or clear picture as to when you're going to go back, or if you're ever going to have to go back full time. That's a tremendous change in the demographics and what is driving people's decisions. So those markets, which you had already indicated were stronger because they were more affordable, just blew up.
Right.
And you can't build enough.
And you mentioned that people could go further away from the job center. They even, of course, can cross state lines. And one of the things that we see today are really those markets that are experiencing so much growth that their infrastructure is really not strong enough or in place to handle all the growth, whether the school systems, traffic. We see in Texas, we're calling them Texifornians because there's so many people that are coming from California. But I'm going to come back to you in a minute because I want to talk about my favorite subject is interest rates and affordability. But let me go to Howard for a moment. So Howard, prior to COVID, hopefully you'll concur, I'd say that the second home luxury market was somewhat lackluster. And while we had, seen transactions were occurring and somewhat market specific, generally second home purchases, it just was, again, lackluster. So yeah. Here we are now, into 2021 with now 9 full months living with COVID and thinking about the the surge being in this segment of the market and discretionary purchases. I call it taking advantage of free money and the stock market's wealth creation. But is it sustainable, Howard? What's happening in your opinion that's changing? Is there secular reasons it's going to continue?
Well, what was sustainable is the fact that since the financial crisis in 08, 09, the single family homes in places like Westchester, Fairfield County, and in Long Island never came back from their pre-recession highs. They were still much lower. They were probably 30 or 40% lower than they were. Okay. And they just stayed that way. And there was a general malaise, and volume was down and prices were down. This has been the first year since then that these markets picked up. And in Long Island, not counting the Hamptons, but in Long Island, we sold almost 8,000 units across Long Island for $5.3 billion. And the average sale price was up 12% from the prior year. So that's just the start of recovery of some of those. And Westchester.
Part of the reason to interrupt, just so that everyone understands why it was lackluster, or why we had seen it kind of left for dead. I think part of it was, if not, tell me if you disagree, Howard, is that many sellers, like those homes that were in Greenwich that were left for dead, were that they were dated and they didn't put the capex in, and those sellers had aspirational expectations, and the value buyer just didn't see the need to buy a home that needed significant hundreds of thousands of dollars of capex. So now, to Fred's point, now they just need a place to get their kids out of Dodge, and they didn't care. And rates had fallen so much that it made it more acceptable to go out and buy that dated house. Do you agree?
That's absolutely true. But it wasn't just older product that was dated, because in Greenwich especially, and in some parts of Long Island, there was a lot of spec building, more so in Greenwich, okay, and some Westchesters in like Bedford and places like that, where the market just stopped, and they were left with huge mansions that couldn't sell. And then all of a sudden, everyone wants to be outdoors. And I would say, I can think of a number of people that also moved out there, bought a house, some rented, but some bought in Westchester and Long Island, and are spending more time there. They still have their city place. They work in the city. And it remains to be seen whether they're going to go back to the city full time, or they're going to keep both and try to commute if they can. But there's no question. The prices, though, I will say, I mean, I've seen things that look just ridiculous. If I bought everything that I thought was great, I'd be in trouble. I'd have 200 houses. I mean, I saw a house that I loved, and it was right before COVID, and it was on the market in the North Shore of Long Island, Old Westbury. Great school system, Jericho Schools, the #1, I believe, school district in the state of New York, and it was on for $11 million. And I was being a wise guy. COVID started, and I don't know what I needed it for, because I didn't need it, but I offered my typical below market offer of $7 million. Well, P.S., I didn't get it, but you believe it or not, that house sold for $3 million.
Wow.
And it was completely redone. And by the way, it was on 10 acres in Old Westbury.
Incredible.
There was really no buyers for things like that.
No, absolutely. And when we think about one thing that maybe the audience may not appreciate, is that prior to COVID, the United States had all-time record low inventory. And the way we think about that is single family listed for sale product divided by households. So I can go back for decades and look at that ratio, inventory divided by households. And people say to me, why is inventory so tight? Why is inventory so low prior to COVID? And the answer was, well, there's just a lot of people that are aging in place, or we have people that have refied into very low rates and they don't want to lose that rate, or we have now very successful landlords that are liking their cash on cash returns that bought during the downturn. Or lastly, people just don't need to do a discretionary upgrade because they don't have enough equity to buy the next more expensive home, blah, blah, blah. Now, post-COVID, inventories have fallen to a new record low, down another 25 to 30%, as sellers didn't want people coming through their homes, or for various reasons, it's gotten so tight, but the velocity is at an all-time record high. So even with all-time record low inventories, for everyone to understand that, velocity is at record levels, and growth in transactions, pending transactions just got released today, even with that lack of inventory, we're seeing 20+% growth year over year in new written contracts. So it's just been a phenomenal, unbelievable recovery. And I think the question for you, because of the remote work phenomena, which is really secular in nature, right? Today, prior to COVID, 6 to 7% of people between the ages of 20 and 64 worked from home. Whether that number, Howard, is going to go to 15 to 20 or 30, we don't know. But do you believe that remote work is really a huge driver to sustain what you guys are seeing in the marketplace?
Yeah, I think it will. I think it will be. I don't think it's going to be what it is now. I mean, look, I look at my own offices now. We have 100 smart offices throughout the country. I think our average occupancy in the office now is about 6%. I mean, 6% of what we normally have come in. Now, I think some of those people are really concerned, and some of those people just said, wow, this is nice. You know, I wore a suit every day of my working life since I was 22 years old, and I haven't put one on since COVID started. And all of a sudden, people are saying, wow, isn't this nice? You can stay home, you do what you want. But that also brought the problems of you needed your own spot in the house. You
Right.
need an outdoor space to walk around without walking into any.
Your kids needed a place to do online
needed a
learning,
place
or
to
you want
play.
an in-home gym, or you want an in-home theater.
So the needs have changed.
Right.
I don't think, and it's the same thing as the migration from the city. Like I always get asked, is New York City dead? And I say, it's definitely not dead. I would say it's in a coma. I expect it'll come out of the coma, and I can't tell you if it'll be a year.
It better come out of the coma, because I'm in New York City. I have a New York City apartment that, you know what, I'm not going to let you list it. I'm going to, continue to hold on to it. Let's switch to Ryan to really talk about, there's this urban flight, right? Everybody's thinking that everyone's leaving the urban core and they're going to the burbs. The multifamily market, if you really look, we do a proprietary multifamily survey. We're really able to find from operators what they're experiencing, rent growth, what's occupancy doing, what turnover's doing, and all the aspects that you watch every day in your portfolio. So I would imagine, Ryan, that you have very different performance in your suburban markets as respects to those metrics versus the urban markets that you are currently in. Give us some perspective on how bad is it? New York City rents down 15, 20%, concessions are through the roof, 3 months free. Tell us what's going on.
So I'm going to talk about South Florida more than New York, because that's where we're currently leasing right now.
And that's better news, by the way, South Florida.
Yeah, let's be positive. I'll be the positive ray of sunshine for everybody today.
By the way, my daughter goes to you and she needs an apartment near Coral Gables. So let me know.
I know this is being recorded, so it's considered done.
Knowing if you're listening, I'm working for you.
So I'll give you a factual stats from the building we just opened. So we just opened a building in Fort Lauderdale. It used to be called Riverfront. Was an old mall, and it's on the river. Class A by all means. We opened it for lease in May, and it's a large asset. It's 640 apartments, but it's 800. It's high rise. Yeah, it's a 40-story high rise 2-phase deal. It's 800 leases, and the discrepancy between apartments and leases goes to that rent by bedroom concept, where a 3-bedroom you could have 3 leases versus 1 lease.
Right.
So true stats. We opened in May and we posted 600 plus leases in 10 months. I guess it's 10 months.
That's phenomenal.
We'll be fully stabilized by April, just considering current trends.
Did you actually lease at the rate you underwrote initially?
So yeah, so you can imagine coming into the pandemic, we opened in May, and Miami in May was, it was headlines in May. Our mayor Francis was on, CNN all the time, and we offer a rent by bedroom program. So he said, oh my God, people are going to say, I can't live with a stranger.
Right.
We didn't know what was going to happen. And Goldman was our lender on there, and they used to call us every day and say, tell us what's happening. Tell us what's happening. We say, listen, we'll tell you every day how it works. So to our surprise, the rent by bedroom program, which offered a more affordable price point, went through the roof. We did all the normal things you'd expect in a building with the hand sanitizer, the mask, the social distancing. That moved quicker than the other product because the price point drove absorption. And, the stats were surprising to answer your question. It was above underwriting.
Above underwriting, okay.
Above underwriting. Concessions, we don't offer any monthly concessions. We offer a signing bonus, but above underwriting in terms of what we plan for concessions. Biggest stat that makes sense now, but didn't make sense to us back then. The people that are leasing, the stated income, where it comes from, it was much higher than what we thought. A lot of people that could afford to live in bigger places, grander places, buy condos, homes, they were choosing to rent. And where the people were coming from, we get these leasing reports weekly, exactly where you think: California, Chicago, a ton from New York. Obviously there's a local demographic, but COVID in some way accelerated our lease. I believe, looking back now, I don't know that we would have been at the same place without COVID, where we thought the opposite in May. And so that's a real time stat that's happening for us. We have more multifamily opening up in South Florida. So it's
You're a big beneficiary of the migration south. And
we
looking
are.
at the rest of your portfolio, do you have winners and losers? You can give us sort of the bookends besides Florida.
Yeah, no, so New York was a loser for us. I mean, New York was tough. What we underwrote in the West Village just wasn't what it was trading for. Fortunately in New York, we didn't have too much for sale product, and our multifamily we had sold last year in Long Island City. So just a bunch of land holdings, but New York was just not a win for us this year. We're typically, nobody's been talking about how bad Miami's been for years. I always say it's always delayed. The first people to know when a market's going south or going north, it's always the contractors, right? Like the contractors are the gossip girls of the industry. So, right now in Miami, they're still not at work. If you go around the city, there's not a ton of cranes everywhere. Not yet. I can't promise. A year from now, that will definitely be different. So, the larger, smarter companies, I think out there are trying to buy as much this year because subs need to go back to work. So the win for us this year is South Florida, where that wasn't the case 16, 17, 18, 19,
very challenging relative, right?
Super challenging. Yeah. I mean, we eke through condo sales. But it's, like Miami, I feel like is almost like no other city in the world in the fact that it turns on a dime. I mean, you ask somebody 6 months ago how they feel about the Miami condo market, they would say, what are you, nuts? Right. You ask me today what they feel about the Miami condo market, I think you get a lot of positive responses, and we're experiencing it. So good news, stay south for now. Yeah, thank you, Ivy. Thank you.
That's awesome. So Fred, back to you. So there's a lot we can chat about, but I think when you think about, the affordability in this country, and we see double-digit home price inflation, and the input costs to build a home are going up. It's even difficult to, in some cases, building homes to get appliances or get interior doors or windows, and there's a lot of supply chain bottlenecks. So when you think about just the ability to execute and deliver the homes that you've promised these customers, how much of the affordability keeps you up at night? Are you worried about the home price inflation, and can you continue to raise prices without creating either sticker shock or just pushing on affordability, assuming rates stay the same for now?
So we're not overly concerned at the moment. As with everything in home building, it'll change, and it could change quickly. But at the moment, the consumer has not been spending as much money on their discretionary items, and certainly not their travel and their trips. And I think all consumers, those who are even renovating their homes as opposed to buying new, are all feeling the ability to spend money if you're fortunate to have a job. We don't want to dismiss that there's a big part of our country that is struggling. But for those who are able to maintain and go forward, we're seeing that they want to use more of their income to either buy a home or renovate a home. And I think in the short term, that will shoot us well and serve us well, that we'll continue to see that as long as mortgage rates go down. Mortgage rates tick up, and we're not predicting that, not with the new government at the moment. Whether their policies become inflationary, we can talk about that in another conference. But in this one, at the moment, we think that affordability will sustain itself. And as you've seen, and as I described earlier, our price point's coming down, actually. Right. Because as we move into the more outer markets, the more travel needed markets, we're able to have acquired and still buy land at reasonable prices in those markets. Anything on the inner core is impossible to buy right now. It's trading up significantly. Fortunately, we have a bunch that we can work our way through as we continue to chase some of the opportunities elsewhere. But those price points are actually coming down. So when you look at it in a global basis, it could be concerning, but when you look at it on a micro basis, there's still a decent amount of affordability and people are willing to travel now to get there. That's
But
the difference.
but you're creating that affordability through a smaller product offering, and tell us a little bit about that particular product on that, call it extremely suburban or exurb marketplace. So how much can you provide in square footage to someone that's buying an affordable home, and is there opportunity for further improvement?
So you touched upon something a little earlier in the supply chain. We were just on a call this morning about lumber is rising through the roof again after it settled down, and now in the last 2 weeks it's soaring again. We had a big plant in Louisiana burned down. There's always something in our industry. It always happens. So the affordability there is as much a function of the supply chain cost there is as land or consumer
Sure.
interest at the moment. And so we're able, our platform at Lennar, where we build inventory, we will have very, very few options so that we can control our SKUs, not confuse our trades, not confuse our suppliers. In many cases, pre-buy, because we know you're going to get this, we're going to give you that faucet or that refrigerator, that light fixture, and we can buy it in mass given our size. That all plays to our size coming into significant advantage as we move out into those markets. So as of now, we offer extensive range, Ivy, too. We keep our number of plans limited, consistent with our business philosophy, but we'll offer in a community, let's say we go up to Ocala or even Gainesville now, we'll offer a community of 1,400 to 3,000 square feet. And we're finding that you can appeal to the entire breadth of market today, and we keep our costs down. So we're meeting the demand because there are consumers who do want the 3,000.
Mm-hmm. And that and I want to go to Howard for a question, but the 1,400 square foot would cost what for someone wanting to buy one of your homes?
Well, it depends on the market, right? Outside of Austin, outside of Dallas,
Gainesville, let's say Gainesville.
So at Gainesville, you'll build a home there in the mid 200s for
Right.
14, 2.25, up to 350 for your 3,000 square foot home, which is still very affordable, even in those markets for a tomb. Any two, if both parties to the home are working, they can afford that in today's mortgage rates, and that's feeding into this.
Yes.
There's still a good amount of affordability.
Yeah. And please, Chuck or Andrea, tell me how much time we have so I make sure that we get some questions in here. Are we doing well on time? Okay, well, I'm going to go to Howard and someone yell at me and tell me if we're not doing well on time. So Howard, so one of the things that, we're concerned about is the backlash of the booming refi market. So today, almost 50% of homeowners actually have a mortgage rate today they've locked in at below 4%. And that climbs every day. In fact, the number of people that have a mortgage rate at 3.5% or lower is roughly 30%. So what happens if rates tick up just to as little as a 4% 30-year fixed? Do you think that's going to hurt the resale market and start to keep people stuck in their homes?
No, because it's always nice to get a very low rate, but by historical way of looking at it, there's no way we're going to be anywhere near where we've been at the high end. So whether it's a half a point more, a quarter of a point more, maybe people will start saying, okay, well, maybe I'll take a small mortgage if I have the extra money, or maybe we'll buy something a little less expensive. But I don't think it's going to change. People are buying single family homes because they want the space, they want the indoor space, they want the outdoor space. In fact, Miami was a good example. The condo market Ryan touched on was pretty poor for the last 4 or 5 years, okay? And then what happened when COVID started, if you look at Miami, what happened is all the waterfront houses sold, then the houses not waterfront sold, and then all of a sudden the condos which are sitting there, guess what happened? All of a sudden the condo sales took off because that's what was left. So I think realistically the demand is there, and I don't think these changes, I don't think we're going to see rates go up much, and I think that it's not going to affect what happens here over the next 3 years.
And also, I think to counter some of the risk of rates going higher, Andrew, you're on. Am I good on time? Do I have a few more minutes? How much time do we have left? 5 minutes?
Okay.
5 more minutes? Okay, I think that's correct.
Yep.
So the thing is that where you look at Miami or South Florida or Central Florida, the benefit of a New Yorker who sold their house, that's a first time buyer home that they may have owned in the sevens or $1 million on Long Island, whatever it may be. Imagine how much affordability that it creates when they come to, a place like South Florida and they can buy a lot more home. Just from that perspective, it probably counters some of the rate increased risk that might have otherwise kept them in their home now that remote work is a real reality to them.
I don't worry about South Florida, because if you keep the exodus keeps going on from other states, high tax states, whatever, they have the plus of lower prices, generally speaking, and savings in taxes, big
Right.
savings in taxes. So that's going to fuel the market I think, for quite a while. I don't think we're going to see a change in that migration for quite a while. And it's not just from New York to Florida. As you mentioned, it's from California to Texas. It's from California to Phoenix and Scottsdale.
The Boise,
And
Utah,
also,
everywhere.
to Nevada,
Right.
Las Vegas and the outskirts and so forth. So any place where people are coming from a high tax state with higher prices, you say to yourself, how could a high tax state actually have higher prices? You would think it doesn't make sense because the housing prices should be lower, but it's not. They were very high prices and paying very high taxes, income taxes and real estate taxes. Now
Sure.
you go to a place that has lower priced inventory and no taxes or very low taxes. It's a home run for the home buyer.
It's a total home run for that home buyer that's relocating. What's happening in certain places, though, it's actually the locals are the ones that are suffering because they don't have the same buying power. And that's more in states like Idaho or in Utah. And some of them, we're seeing some challenges. But just going back to you, Fred, one of the things that's been, I call it now, the new prettiest girl at the dance is single family rental, I should say, build for rent. And you've just announced that you're going to allocate a few $1 billion to single family rental, build for rent. Talk about the strategy and how does that play into just the ecosystem in your opinion? Is it creating that counter-cyclical stream of earnings that you'd hope to mitigate if for sale weakens?
Yeah, it's still a little bit of a hangover of 2008. There's still a certain part of the population that just never got back into home buying, but always wanted a home. So there's a natural population demand there. Plus, people are still transient by nature. That hasn't changed. And by renting, if they decide to change their job or their location, it's very easy, and it's affordable because we are able to build these homes. When you look at what it costs Ryan and our multifamily group on a square foot basis to build a 1,400 square foot apartment versus what we can build a 1,400 square foot home, all the economics make sense if people are willing to commute and not be in the walkable inner city anymore. The SFR program or the BFR, we call it both, is going to have, and it already is having a liftoff. How long it goes, we'll see. But for the near term, it goes right in hand with the young couple with 2 kids who may not have the deposit, may not want the risk, may want the flexibility of moving in 2 years, not sure they're going to like living in the suburbs. So we think it'll be a stepping stone for them actually buying a home because there's still some trepidation in their desire to move out of the urban. They're still a little hesitant about that. But what we're finding is as soon as they get into their home and they get a dog, they get their second child and they put up a play set, all of a sudden, what city, what urban market, and they'll go visit their kids there someday. So it's a natural transformation we're seeing in the SFR program. BFR is just a strong outcome of the supply and demand right now.
And millennials actually through surveys, their number one priority when considering buying a home is they want new and they want amenities, the concierge millennials or they need to have everything provided for them. At least that's what we see. As we think about your business model for the build for rent though, competitively, right next to a for sale product, are you worried about cannibalization? That there could be some very similar, same house, but just doesn't have as many bells and whistles? Or how do you differentiate and what's the rent price versus the monthly mortgage payment differential?
So I think that's evolving, Ivy. I think those are great questions. And I think we're all learning right now as to how deep that market is. We're seeing out of the box a strong demand for if the rent and the cost of owning are close, Right now, we're not seeing the buyer differentiate. It's more that personal preference as to where they want to go and why, whether it's the transient or uncertainty issues, deposit issues, like I said. So we're not seeing much of a difference right now in demand. Both are having a strong demand. And it's exciting to see that. It's giving young couples, which is a lot of the SFR, although interesting enough, we've seen in active adults who are selling out of their home and cashing in, and then renting a home nearby, and taking their equity. They think they've been through this game enough. They want to sell high, and they think it's probably a good time. So we've actually seen some of that demand creep into SFR as well. So it isn't just the young. We're actually seeing the other side of the scale coming into that game as well. So we think it's got legs.
And just to the differential, because I've heard that the single family rental rate per month could be $200 to $300 higher than the for sale monthly payment at today's rates. Is that kind of in a range that you think is reasonable?
Yeah, it ranges, Ivy. I don't think yet we have a good enough statistics. I think these are spotty at the moment. I think in the next 12 months, you'll see quite a few of these evolve. I think every underwriter, our own group and the outside groups, the H4Rs, they're all struggling right now with that differential to understand how far they can press the market. So we're going to learn more. Generally, we know if it's in line, there hasn't been a demand issue. We don't know yet the gap difference, whether it's going to impact demand. But at the moment, we're still being able to rent very close to what the cost is for ownership. They used to think about taxes, right? When people used to buy, you used to get the tax benefit and think it was great to own. That's kind of gone away in the last few years with SALT and otherwise. Not as big an issue anymore for people in considering home ownership, the tax benefits any longer.
Well, actually talking about, changes in taxes, maybe this is a good question, shifting to you, Howard, just with respect to the Biden administration's proposals to really provide more affordable housing, providing the consumer a $15,000 tax credit that's advanceable and permanent. They're looking at forgiving $10,000 for those that make in student loans less than $125,000. They're talking about reducing FHA loan premiums. That's at least rumored. Is any of that concerning to you, or do you agree with it? And if you were at the helm and you were trying to help housing, would you have other ideas of what they should be doing? And I know I want to ask that to Fred as well.
I think that putting the SALT deductions back in is going to help, but I think the plan really is they're not going to put it in for very wealthy people. So they're going to probably take that $10,000 limit, and from what I understand, speaking to people, maybe raise it to $20,000, $25,000. So that'll cover a lot for a lot of people at that end. And so I think that's a good thing, a very good thing, again, for housing, versus rental, if they do that. But again, it depends on what market you're talking about also. Rentals in New York, if you want to talk about the rental business in New York, I'm sure Ryan could comment, thank God the stuff he's been doing has been in Florida, because every owner that I know that owned a big rental portfolio before they started with all the change in the rent control and rent stabilizers laws and everything else, they told me their portfolios, and these are families, dynasties that have had buildings for, in 70, 80, 90 years, portfolios, they're all down 50% in value, 50% in one felt swoop of the pen in changing the rent laws. So that's tough.
So if you think about one of the challenges that we know, we have record tight inventory today, record low inventory. We have ability with interest rates as low as they are to provide more affordable housing, but there's limitations on that. So just going to you, Fred, if you were at the helm and you're sitting with the Biden administration, do you think juicing demand is what we need, or do we need more focus on the supply side with development costs rising, impact fees, municipalities all want affordable housing, but just not in their backyards? How do we deal with what is the true bottleneck of providing more affordable housing?
Well, along those lines, you listed a lot of things that are adding gas to the fire. Immigration policy is also going to be another big supplier of gas to this program, where people can come out of the shadows and buy a home now and document their citizenship. So, but you take San Francisco, Ivy, is probably the craziest city in America for many reasons. But there's more screaming about affordable housing needs in San Francisco, except when you want to build it in that local neighborhood. And local neighborhoods in San Francisco are really powerful as in California. So I've been doing this too long to have a belief that we're going to actually change government policy on allowing for affordable housing, because there's too much local control around the country. And it's always when it becomes in my backyard where the affordable home, we're not talking about HUD housing, we're talking about just good solid. You can't win that. I mean, we lose it all the time. And we bury it inside of larger communities now where we can provide some affordable housing in certain markets, allow it and promote it. But we can't win the political program on allowing us to build affordable housing by taking costs out of the system. I mean, when you look at fees in Florida, in particular, California, we're spending $30,000 or $40,000 a home to supplement local municipal fees. How do you build affordable housing when you start out with land site development and an impact fee of $40,000 and there's no concession for affordable housing reduction in fees? It's a terrible political game that we haven't won, and unfortunately, I'm not optimistic that we will win it.
Yeah, no, and I think that if we had something at the federal level to sort of work with the local municipalities, some type of tax incentive, or maybe there's some way to educate them that that's really the bottleneck to giving those people that are struggling affordable shelter.
You know, but when you go before, and I've done it my whole life, before planning boards and city commissioners, and you've got a great affordable project, or you want to build 100 affordable homes on this project, at the end of the day, it doesn't matter the policies, how much we've educated them, who we bring into the municipalities to convince them otherwise. We can't get them to vote yes. You know, so I'm not sure it's a federal policy that's going to help us here. I think it's the students at the university and the next generation who hopefully wrap their heads around this.
Yeah.
And help us.
Leading to you, Ryan, which your business model of leasing bedrooms, you know, we call it co-living. So thinking about that concept and really providing people that can't afford to rent a full apartment on their own. Is this a strategy that you think is the consumer or the tenant looking for more of that today? Or you think it will revert back to just, you know, pretty much people renting not just a bedroom, but renting an apartment? Is your strategy to do more renting on a per lease basis, just bedrooms, or do you go back to renting full apartments?
No, I think that the feeder market that we hit, I mean, we're in the affordable business, but not as Fred was referencing the HUD affordable business. And you look at the price points, we actually hit some of the metrics that the AMI requires for affordable living. And, you know, I think I'm in total agreement with Fred. Like, I don't think it's federal. I think on a state level, you need impact fee credits for market rate affordable living. I mean, truly, you got to just really incentivize developers to say, hey, go build a market rate apartment that's affordable. And you know, you can't change the hard cost market. You can't change the lending community. So the only thing to control, the only variable to control is what type of incentives we provide everybody. Our new county mayor, Daniela Cava, I've met with her a bunch of times on this, and this is part of her platform on how do you get developers to move their bums and build more affordable housing. And I said, provide an incentive, you know, provide an incentive that's, and then, you know, so what is that incentive? And the incentive, I think it's local. I think it starts locally with impact fees and, you know, local tax credits, if you can. This is our answer to it, Ivy.
No, but that's really the only way, not just in multifamily, that's the only way you're going to get it in affordable housing to continue to create the sprawl we're seeing today. And one of the things that Fred, you mentioned is we didn't mention is the Biden administration is planning on providing a path for 11 million illegal immigrants to become legal citizens through whatever processes they do. But we also have the Dreamers, which are those that were born in the United States that were we're still illegal, 800,000. They're going to be offered to utilize FHA financing. So that will really spur demand. But I think generally speaking, we are watching the housing market and see what, you know, I want to make the analogy to 2013. For those of you who remember, we were running so hot that builders were just stepping on the gas and raising prices a little egregiously. It felt like we were going around a curve 130 miles an hour, and it wasn't going to end well. Right now, it feels like it could be more sustainable with home prices continuing to rise, but rates have to stay low. So I think everybody, we've got about 10 questions in the queue. I think, why don't we go to the audience and see what we have here? So I unfortunately haven't read all of them, so I'll try to do what I can. So here is a question for Fred and for Ryan. What range of discounts in reference to development costs are you building in South Florida market for Class A multifamily product?
Fred, you want me to start here? So we're buying a job in Orlando right now, and same subs in Orlando that are in Miami for all intents and purposes. Right now what we're seeing in high rise is a 2012 pricing. We bought jobs in 12, 13, 14, and 15 in Miami. I think from 15 to 12, it more than doubled in certain trades. Not all trades are equal. So today, it's I think the difference, Tybee, which you referenced before, the difference in pricing between, it's not 2012 or 13, because it's I think from the lending side, lenders are not lending across the board now. It's not easy to get a construction loan. Everybody believes debt's so cheap. Let me finance a job. I can tell you that we're in the market trying to finance 5 jobs for all over $100 million. And, it's a difficult lending community. So that is going to hold pricing down from a construction cost stance for a minute, because there's just going to be less jobs going vertical. As the lending community opens up, I don't think that's true next year, and definitely not the year after that. So at this point in time, for this moment, pricing it's good. I mean, we're seeing good numbers out there from Shell and MEP and Glass and stuff all the way down the line. But again, that's going to change. This statement is, these things move in 30-day increments or less. So that's what we're seeing right now. So we're buying as much as we can, and we'll stop when the train gets moving too fast.
Great. And Ryan, just quickly for you, your project on Miami River, what are the shorter term leases or annual?
So we do all annual in South Florida. That being said, South Florida will always be transient, and we get an infinite amount of requests for 6-month leases, or even shorter. We really don't do shorter than 6 months, and we charge them a premium, and people say all day long, because the flexibility is worth the premium. We really try to live in the conventional box of what lenders and future buyers want to see, which is truly a 12-month lease.
Got it. Very helpful. Fred, do you want to add anything since you have a multifamily operation as well?
Yeah, we're seeing costs rise on the product side right now. And we're hoping the labor side will level off and come down as the immigration policies change. So we'll see. We're right at a very tenuous tipping point on where the costs go. Ryan's right, it's been depressed, but we're starting to see some rebound in those pretty significantly.
Yeah, absolutely. We see probably, because we analyze the building product industry, price increases coming from every category, ranging as high as 5 to 9%, with some of those product categories on allocation. So it's coming, and it's only going to make it more challenging.
And Ivy, to add on there, a good friend of mine runs JMA down in South Florida, and he says his estimating department's never been as busy as they've ever been. He says nobody's going right now, but it's the estimating departments across the country. Everybody's pre-conning. So Fred's right, it's coming. It's just, when is it coming?
Well, this question is more broad, and I'll throw a jump ball. It's someone who's got a focus on the environment and thinking about what is better for the climate control and the awareness of sustainable living, with the ticker to irreversible climate damage approaching us, and considering the change in political administration. What things may be done to incentivize space users to live in high density building areas that have significantly less of a negative impact on the environment? I guess I would just start by saying that comes back to, I think, what you said, Ryan, is by providing more incentives to developers to make that a more desirable place to be. But maybe you want to take that.
Yeah, for me, I think the equation is pretty simple. I mean, developers are capitalists for the most part. I mean, that's who we are. I mean, you want to get them to move and build more product that's in the affordable box, or that's environmentally sustainable. You just got to incentivize them. I mean, there's incentives have been going on since the beginning of time. I think the problem with incentives, as Fred and Howard were referencing, it gets red taped. It gets bundled up in complex packages, and local communities that they want affordable. They don't want affordable as their neighbor. Okay, well, so I think the goal is, if it's even possible, is to untangle the complications of how you provide an incentive. And on a local level, I mean, Fred's right. You go to a local planning board. I've stood in front of many of them, and while their initiative is more affordable housing, when you go and present the product, it gets shot down often. So there's some hypocrisy there to a level, and I think the answer is, like, how do you simplify incentives so people can just go. You just want developers to go, really.
Hey,
Right.
I mean, let me jump in on the for sale residential side. Sustainability is a hot topic. It has been for years. It's the product catching up with the desire and the cost of the product. We're all over it. I could spend an hour excitedly talking about all of the sustainable features of new homes, including going to zero carbon footprints. We're doing an experimental community over in Babcock Ranch over in Fort Myers area, which is a all solar powered community. And so there are some really, really exciting things that have been evolving. And one of the things that happens during a boom period like now, a lot of those ancillary technologies can develop. There's money available to support those. And I think we didn't talk about it. It's a big side benefit for companies like ours where we can invest because we have extra capital to focus on the sustainability. And then other industries as well, because they could see the demand. So we think, and California's going all solar. That's a big part of it. We've got a solar company. We bring solar across the country now. We're still fighting governments and utility companies from the dinosaur age who don't want us to put solar unless they own it or control it. So it's another political battle. But the sustainability in the for sale residential is booming everywhere, and it's exciting to be part of.
Can I ask Fred a question? So everyone likes the idea of sustainability, but my question is, do they pay for it? If you said you could have a house that has a lot of sustainability features and it's X amount more than a house that doesn't have the features, does the average person that's coming to buy want that? Do they pay for it? They all want it, but I doubt that so many of them will pay for it.
It's a great question, Howard, and it's been the question for the ages. And typically, no, but we're getting smarter in developing communities that are entirely sustainable, so that it's no longer an option. We're building it into the design, and that's from the landscape to the streetscape to the type of material in the community to the type. So if you offer it as an option and a homeowner sees it's $5,000 more to get it sustainable or not, they won't pay it. But when you can design it in and buy it in bulk, we will sell those communities faster as we market it that way, but it can't be an option.
Yeah, we've heard the same thing, Howard, that everybody wants it, but they just don't want to pay for it. So it
I
becomes.
speak to landlords when the thing came in with the green buildings, office buildings and so forth. And they all said, oh, all the tenants loved it, but not one would pay 1 cent more in their rent to have it.
Howard, we just, in our rentals, just took 20 units off the block, put in air purifiers, put in water filters. I think we charged a 5% premium. 0 people took it. 0. You're talking $30-40. Zero.
This company Delos.
Know them well. I know Paul Shalia. I know all of them.
So where they've been successful is they've been going into hotels, take a block of rooms, put in the product, okay, and show the hotel how they could charge. So it's interesting if you're going into a hotel room and instead of paying $300 a night, you have to pay $320 a night. You may just do it, and they've had good success with that. But I don't know how wide that market really is.
So just moving to one more question on sustainability and thinking about the environment. If with solar and thinking about all the things that you're doing for sustainability, Fred, right now, if you had to gauge the comparison of living in more of a denser apartment living, the energy savings is so much more significant than living in single family, which takes 3 times as much energy to be in the commuting and cars. Do you think that there's other things besides solar panels? What else can you do from just save, that's climate friendly?
Virtually everything, every aspect of a home, from the type of drywall you use to the type of roofing materials to the type of insulation to the type of plumbing material to the amount of water usage you use to certain devices to protect against leakages. I can go on and on about the series of elements. Thermo, we've looked at that as an alternative that's still a little expensive, but getting there. So there are so many products coming out. And then just revegetating farmlands. People don't give enough credit for the sustainability of taking a farmland, which we all love farmlands, but they're not the most economic green type of business. We've had more spills, environmental spills on farms than probably any other property we built on, including urban properties, because they weren't regarded over the years as something that they were by natural green. So we've cleaned up a lot of farms and a lot of toxic areas and farms. And then you go back and you put on, 10,000, 20, 30,000 trees. So there's all elements of sustainability that we need to think about. And along the density side, as we're working, for example, in Babcock Ranch, these are very, very closely knit homes. These are going to be 28-foot, 30-foot wide homes. So you're getting the density up. So that 1/3 ratio between the product and the density will come down significantly in the short term and the long term.
It's very exciting. I especially like the leak detection. That's going to save a lot of money and reduce insurance premiums and be definitely more sustainable. Really, for you, Howard, this question: what are your delinquency rates in Miami? Experiencing any fraud or issues with valid income validation? Have you heard anything from any of your agents? Any issues?
No, not really. Really hasn't been, I don't think, anything different than the most normal circumstances, pre-COVID. I haven't seen with COVID. I think that, I think what's happened is the requirements have become a little bit tougher from a lot of landlords because they're worried about COVID.
Mm-hmm.
And especially now if they talk about a national no foreclosure and no eviction period, which I think Biden is talking about. I think he mentioned it in a couple of speeches, going to March 31st or maybe later. Then it's going to be tougher because they're going to have a lot of people that are just not going to leave. So they're going to have to be more careful in their underwriting.
Well, right now we've got 2.7 million people that are in forbearance in terms of not paying their mortgage, which is down considerably from where it initially was over 4 million. But Ryan, with respect to your tenants, are you seeing collection challenges and just recognizing there is a eviction moratorium in place?
Yeah, it's funny. We don't have collection challenges. I mean, Miami historically always has greater delinquencies than a lot of other major cities. We don't have collection challenges. We have people that live in the building that have not been paying rent since March and just refuse to leave. And so, you got the people that pay, and then that's normal percentages. And then you just have I want to say in a building in downtown, there's 460 apartments, something between 30 to 40 apartments, which is a significant number, have been living, there since March. And Howard's right. If it comes to March and there's a national moratorium on evictions, I guess all bets are off in that case. And I don't know what's going to happen as a result and how that's going to affect the buyer market and so forth. So it's interesting times, to say the least.
For sure. So this question, I didn't say the names of the people asking questions. I probably should have done that. Carlos Bruno, if I'm pronouncing your name wrong, I apologize. Is Lennar active in respect to iBuying? Or no, sorry. Can you please ask about single family rentals, which we talked about a lot already, and how does that impact the for sale market and demand for apartments? So I think we kind of hit that. Is Lennar active on that? We talked about that. Similarly, the impact of iBuy. Sorry, what's your view of iBuying?
So great topical discussion with Open Door, one of the early investments and endorsements by Lennar of iBuying. It is absolutely going to be the future. Howard, I don't mean to put the realtor out of play, and I'm sure you will adapt to it. But in the non-urban areas and maybe urban, iBuying will become the way for the future of how homes are bought and sold. It's a natural. The problem with iBuying today, there isn't enough competition. So consumers don't think they're getting the right price. And in a rising market, what you put on the market today may be worth more next week. And in iBuying, it's so fast and easy that you didn't give yourself a chance to ride up the market. But the market won't always be this way. We're in an exceptionally hot period. But when you get an iBuying platform, much like Trivago, you go online and you get 8 or 10 iBuying offers for your home. That's quick and easy. I do think that's going to become a big part of the future of standard residential homes being bought and sold. Maybe not the high end, but across the vast majority, it's coming, and we're in the early stages.
Howard, how do you feel about iBuying?
We haven't really seen any of it, and it's not going to happen in most of our markets at the high-end markets. It's not happening in Palm Beach. It's not happening in Miami. It's not happening in Beverly Hills and Greenwich and other places. But I believe it is attractive for people. And we've thought about offering something different, because the biggest problem, not the biggest problem, but one of the problems we have when someone wants to buy something is, especially if we're selling a condo and they're moving from a single-family house, is they don't want to buy the condo until they sell the single family house. Okay. So we tried to come up with a program where if we priced it we priced that single family house, we would give them basically a put, okay, at a certain price. So that's about the closest we've come to it. But really, very few people ever took us up on it. And maybe again, because I'm talking more higher end product. And it's a little bit harder because the differentiation on the higher end product, could be a lot more. And it's a touchy subject sometimes, but we try to develop some ideas to help move product where a developer wants to move it by offering to buy what they have now, so they can buy the new condo or house or whatever.
What about the idea too that consumers that may not have the wherewithal to, in a high end, let's say condo sale, to fix up the condo, or for sale house in Westchester, Connecticut, are you willing to do what Compass is doing, which is provide and the repair and remodel expenses?
I don't know if they're doing it anymore.
Oh, really?
I think I'll tell you the problem that I see in it. Okay, is if you give someone money to fix it up so you could sell it quicker and at a better price, and then you don't sell it, okay, you have an unhappy person. And if you think it's going to be easy to collect that money that you lent that person, good luck.
Right.
Good luck. Because they're going to come up with 20 defensive. You didn't do the right job. Your broker wasn't so good, and it creates so many other different liabilities. It's scary. It's scary.
Right. No, absolutely.
Ivy, an aspect of iBuying, not at Howard's level, but one of the other advantages of iBuying is that they're creating the program so that they'll inspect the home before they put it on the market. They'll repair that home, and then they'll give the buyer an inspection report from a third-party company. For a lot of America, that is very attractive, because when you get that home inspection report, that is the most anxious part about selling your traditional home, particularly a home with years. So iBuying is already moving into that platform, which is going to help every buyer or seller sell their home, make it easier for the buyer. And that's really the whole iBuying concept. It's just a more fluid, easier system to move in and out of, right? Less friction. People hate selling a home, and they can't stand the inspection.
I think it's great. I think iBuying at those levels is a great concept for people.
Absolutely. Having sold a few houses and having small children that are now big, and being a consumer, it's a nightmare to have to keep the house clean and everything that goes involved. So it's a great concept, great business model. I think we could wrap up. I think Andrea told me we have another minute or two. Just Ryan, one of the questions I have for you from Luis Flores, a question for Ryan. Branding has become more important in the marketplace. And I was wondering how much time they put into choosing brands for their projects or co-branding opportunities.
Yeah, so we are building the Waldorf Astoria in Miami. I shouldn't say building, we're launching for sale the Waldorf Astoria. An education on, at least for our group, on getting a brand on board. It's a process. I mean, it's especially with, and it's not just that it's Hilton as an institution. Hilton views Waldorf as their coveted brand. After you go through the process, you understand what makes a Waldorf. And it's supposed to be a little bit painful because they force the developer to hold to the brand standards, which is like 1,000-page book, if you can imagine, on everything that you got to do in there. So, especially in a city like Miami, and I think this is true globally, we think our name carries a lot of weight. We think P&G carries a lot of weight, but compared to a brand like Waldorf, you bring in a brand because of lift, because of international recognition. People are married to a brand. And I always tell people, I don't need to explain who my company is if you just know that you're building a Waldorf. Explains it to me. So I think that and Miami's, I think, pioneering this. If you go across the city from the Ritzes and the Four Seasons and the Porsche and the Aston Martin, and there's Baccarat coming, there's a ton of brands coming, and Howard definitely knows this better than I do. I think from a sales stance, it makes the sale easier. It makes the sale stand up for itself. And with a reputable developer, it's kind of a powerhouse team. So we're a huge fan of it. We see ourselves continuing to enter that space with other brands. And I can't.
Andrew, do we have time for one more, or are we done?
We're pretty much done. It's been a fabulous discussion. We can't get people to stop asking questions, which is the sign of a wonderful panel. Great information in my email. I'm getting lots of compliments there too. This is not the last one. This is just the first of 2021. I am going to ask, I think that Natalie Bixby can throw up the list of panelists for our next one, which is February 26th. And you notice that it does not have a title. What we have gathered here are the participants from our real estate conference from February 28th of, whoops, that should say Friday, February 26, 2021, because our conference was February 28th of 2020. And we all know that the world has changed since then. So we thought of a variety of ideas to put up here in the insert your own title, but none of them are really fit to print. So if anybody has a good idea of how you might describe the last year in the commercial real estate business, please let me know, but know that we will have our panelists from last year back and focus on what they have learned and what opportunities they see going forward. So thank you to all of our panelists now. We hope we'll see everybody February 26th for the next one. And at that one, we'll let you know what's on tap for March. But these have been fascinating sessions, and I thank you all very much. Have a great weekend.
Thanks.
Thank you.
Thank you.
Thanks, everybody.
Fun.